So a word before we head into today's video. This is a continuation from what I said on the Q&A video midweek. The amount of spam comments that I'm getting is pretty much off the charts. It's 2 for 1 with real comments, so it's a lot of work weeding these people out. It's all of two types. A very small amount is porno sites. They tend to go away after 2 or 3 blocks. But it's the crypto scammers that just are relentless. And they have 2 different strategies they follow. One is this continuing chain of comments like, oh, you know Expert Janice? Oh, I know Expert Janice too. I thought I was the only one. I'm making $18,000 a day with Expert Janice. Here's Expert Janice's number. Obviously, it's a scam, right? And the other one is somebody who makes it look like it's me by using my channel logo and responding to you saying, thank you for the comment, let's connect, and giving you a WhatsApp number. I will never, ever do something like that. And if I do want to talk to you, I'll talk to you directly. I won't tell you to contact me on WhatsApp. But I do want to keep the channel clean. There is software you can use, third-party software, that will clean up your comment section after they've left the comment, and it blocks them at the same time. But these are bots. And they create account after account after account, and they subscribe to your channel again and again and again, so that the moment you release a video, they start hitting you right away with all the new accounts. So it's this never-ending blocking game that you're involved in. Since they use certain words, I can put certain words on the block list, but they spell Bitcoin 50 different ways. BIT-COIN, all capital letters, B.I.T.C. So you have to end up blocking every possible variation that they have, but the algorithm just keeps finding a way around it. If they post a comment and it's blocked, they'll change the word of Bitcoin and they'll post it again until they get one through, and you have to keep going and going. I can do certain things with the comment section. One is here, hold all comments for review, but I can't do it for specific videos. It's channel wide. Well, I've got hundreds of videos, a whole bunch of CFA videos on there. To start monitoring every single comment that comes in is even more work than I would like. So right now I've got hold potentially inappropriate comments for review, and you can come up with a list of words that you can put on there. So I'm going to start there. Gradually, I'm going to see if I can't get it down to a little bit of nonsense that I can deal with. YouTube has shown itself basically unwilling to do anything about this. It's not that they can't, they're unwilling because the bots create subscriber accounts so that they can then say we have this increase in subscribers. So for example, over the last year, they claim to have 200 million more viewers than they had the year before. However, if you Google this, by the way, you'll find this is true. Why are my views down year over year? I'm not the only one that's noticed this, but almost across all creators, there's this complaint that, I used to get this many views, now I'm getting half of it. And I'm of the same in the same position. 2-3 years ago, I'd get somewhere around 30,000 views a day. Now it's hard to break 12,000 views a day, even though I have more subscribers. And it's because most of those subscribers are bots. I can't unsubscribe them, I can only block them. They don't unsubscribe themselves, they just keep generating new accounts, and it's just spam everywhere. It's not just me. It is a growing problem on YouTube, and YouTube just, I don't know, just appears unwilling to do anything about it, even though they could do something about it. They're in the best position to do something about it. They seem absolutely unwilling to do anything about it. They could authenticate each account that is set up. I'm beginning to sort of side with Elon Musk on this one with Twitter, in the sense of, well, how many bots do you really have? Because, I get 2,000 subscribers a month. I'm going to go ahead and say at least 1,200 of those are bots. 1,000 to 1,200 are probably just bots. And it's an algorithm that you're fighting. You can't win on this algorithm, and it's getting worse and worse every single week. So I'm going to try a few things first before I run off and set up a Discord chat group, because apparently they can enter the Discord chat group, and Discord's got a whole bunch of problems with this as well, and they can ping you directly and I'll never know about it, so I can't even stop it. The other alternative is to put the video on my site and have the comments section on my site, which means you'd have to set up a free account on my site, and then you can watch the YouTube video from my site. That would stop the bots, because they're not going to go through that process at all. You just turn off comments and that's the end of it, and then they just go away. But it stops the organicness of what happens and what goes on, and I don't want to do that. So bear with me for a couple of more, well, I mean, you don't see what I have to go through. I should say I'll bear with it for a couple of more weeks, and I'll see if week by week and video by video I can't fine-tune the list of words I have to eliminate these people. Maybe putting the word expert on the list might get rid of it, because they always use the word expert. And that doesn't seem like a word that you'd block. It doesn't seem like a logical word that you block, and it doesn't seem like the algorithm would then say, let's change the word expert. We believe that's what's blocking us. They would probably change the word Bitcoin, because they have like 50 variations of the word Bitcoin. So there we go. We're going to be in an experiment for a couple of weeks, and I'm going to see if there's any way that I can tweak this in such a way as to minimize the amount of this nonsense that's going on. And, you know, again, if YouTube doesn't do something about it, they risk losing a big part of engagement, which is the comment section. Let's jump in. Okay, lots of interesting stuff to cover this week. Let's start with our Treasury yields, our bond yields. All hit new highs last week. When we get to equities, we'll see that they hit new lows last week. So we have a week of excesses here. All of them throughout the week hit new highs, year-to-date highs. Not on Friday. It was just the 1 month and the 2 month closed out the week hitting the highs. The rest was during the week at some point. The next FOMC meeting is November 2nd. That's 31 days away. Still a little too far to handicap based on what we're seeing. We still have a jobs report to get out of the way coming up on Friday, and we have another CPI and PCE inflation read coming up during the month, so it's still too early to handicap this. This will be interesting. The September minutes are 10 days away. We are less inverted than we were last week. The curve did steepen all the way through all the first four measures of curve steepness that I have here, but we are still inverted on those four measures, and the 2 to the 10, which is the primary one that is watched, is now 88 days inverted. When we're handicapping the probability of a recession, it's largely subjective. I haven't come across any meaningful model that has inputs that I could look at and say, okay, well, this model has done a good job in the past of predicting recessions. The simplest model for predicting recessions has always been the inverted yield curve. Every recession has been preceded by an inverted yield curve, but not every inverted yield curve leads to a recession. What makes a recession more likely are two factors about the inversion. One is the depth of the inversion, the other is the duration of the inversion. The deeper the inversion and the longer the inversion, the closer to 100% probability you have of a recession. And not just depth and duration of the 2 to the 10, but the quantity of inversions you have. The 5 to the 10, the 2 to the 20, the 10 to the 30, because there are different measures of inversion throughout the yield curve. So the more inverted the yield curve is at all measures, the deeper those inversions and the longer those inversions, the more likely a recession will be. It finds its way into that result in two ways. One is expectations. If we believe that an inverted yield curve leads to a recession, at the margin, some decisions are made in anticipation of a recession, whether it's a pullback in spending, a pullback in investment, a freeze on hiring, whatever the case is, that starts the ball rolling. Other businesses then make more active decisions to suspend all investment or to cut staff maybe 10% or 15%, or as we saw last week, Meta, right? A hiring freeze, the first time ever for a hiring freeze for that company. Now that could just be because, well, it's time for it to transition into a stable large cap company. It's no longer in growth mode, but still the timing is coincidental, right? So what we're paying attention to is the number of inversions, the depth of that inversion, especially on the 2 to the 10, and the duration of that inversion. This is 88 days. I think we got up to last week -51. We're back around 39. We've been hugging around the 40 basis point inversion for quite some time. So I would say that the odds are greater than even for a recession, and usually it's 2-3 quarters out. So if we're looking at Q1 2023 into Q2 2023, that's probably right. I know that a lot of economists are calling for Canada to enter a recession either later this year or early in 2023. Fed balance sheet ending September 28th dropped another 18.7 billion. We're now at 8.272 trillion versus 8.291 trillion the week before. This drop was primarily from mortgage-backed securities, 16.7 billion. The commitments to buy MBS are done now. I believe they're mostly done or all done, which means you just have runoff from the MBS, and this is monthly. So I would expect in and around the same amount next month as well. For bonds for September 30th, there was still another 33.8 billion maturing, which was well within the cap. So this was as of February 28th. We're past September 30th, so you can take this down another roughly $34 billion because that happened on the 30th. Throughout October, there's 43.6 billion in bonds maturing, which means roughly 16.4 in T-bills will also be allowed to run off to get to the $60 billion cap. And you'll probably be somewhere around 17 to 20 billion on the MBS. So given the bonds and the MBS, runoff should be around 80 billion, somewhere in around 80 billion for the month of October, on top of all of the rate increases that we've had so far. When we look at the handicapping of the November meeting, last week there was a 73% probability, or the market was placing a 73% probability of going 75, and last week I had said that from where I stand, I don't see a compelling reason for 75 for November at this point. Now that may change, but I didn't see a compelling reason why you would need 75 in November. But here's the thing. The Fed, and I'll talk about it over here, the Fed can't tell the market that. The Fed can't tell the market anything positive. The Fed can't say anything about what it thinks is reasonable or realistic. It has to be completely silent on that, and it can't give the market any sliver of daylight on this one. Well, look what's going on this week. That's dropped to 53%. We're at about 47% on the 50. I think that's the right move. I don't see much of a compelling reason why you would want to go more than 50 as long as you continue this policy here. Year end. The distribution here is heavier towards the ending at 4.5 or 4.75. 4.5 is another 125 basis points of hiking. This is 150, which kind of doesn't make sense given what we had this week, but this is the distribution. I'm still here. I'm still at 4.25. I'm a 50 and a 25 for December. So I'm sitting over here, which has the lowest weight. We'll see what happens, but from where I'm sitting right now and from what I'm seeing, I can't see a compelling reason why you would want to front end load that much on top of what you've already front end loaded when this is another tool that the Fed is using right now to get what it wants. If we think about November moving 50 basis points from 3.25 to 3.75, the 2-year usually leads that, and then usually has about a 40 basis point spread. So let's add 90 basis points on to 3.25. We get to 4.15. And the 2-year sitting at 4.22, which is, the 50 basis points and then maybe a little extra for fun. So I think the 2-year probably has it right. It came down from 4.3 down to 4.22. I think that the 50 makes a lot of sense. The market has already done it. The market has already moved. In anticipation of the 50, the market anticipates it and will move ahead of that 50. So it's not as if we have to wait till November 2nd for rates to go up 50 basis points. They already have. That's what expectations will do. It will price it in. So they've already increased rates 50 basis points. So they basically brought that 50 basis point rate increase forward by 31 days in essence. So when they get to November, a lot of that tightening that they were going to do in November with 50 has already been done through the month of October, which is why I don't see a compelling reason to go 75. A compelling reason to go 75 is if the market rallies throughout October and this 4.2 drops to, let's say, 3.7, 3.6. Well, at that point, you got to push up the 50, and then you got to go another 25 to slap the market in the face again and say, when will you get the message, right? So I think if we follow this policy here, and I'll explain that in a second, I think 4.25 is the right ending for the year. If we listen to what the Fed has been saying, it has been very consistent since Jackson Hole. We're going higher. We're not pivoting. You're out of your mind if you think we're pivoting. There's going to be pain. People are going to lose their jobs, period. And no one has diverged from that. No one. So, when I see things going on, I like to, sort of think, well, why would I say something like that? I may say something like that because I'm telling the truth. And that's exactly what, at least, I believe I'm going to do. So I'm telling you exactly what I believe I'm going to do. The other reason I would say something like that is because I know it has an effect on you and I need you to behave in a certain way. So while I may not believe that I'll do it, I need you to believe that I'm going to do it, because the last thing I want is for another one of those ridiculous rallies that happened in the summer. Because if we look at that rally, keep in mind the inflation read before that rally came in at 0. Month over month came in at 0. It looked promising. And then you had that rally, and what was the next read? High. Why? Because financial conditions were loosened by the market prematurely. So the Fed does not want that to happen again. So the Fed may believe secretly in a room, we're not going to 5%. I don't even think we're going to 4.75%. Maybe even we should be done now. But you can't tell the market that, because the market has shown itself completely irresponsible with that kind of information and will work against us. So we have to tell the market something so that they behave in the way that we want them to. We have to make the market a tool of policy. Not an enemy of policy, but a tool of policy. And how do you do that? You work on expectations. So there is a high possibility that the Fed is lying. Not so much lying. Let me change that. It's a possibility that the Fed is not telling the truth. And it's also a possibility that the Fed cannot tell the truth at this point, because the market has shown itself to be irresponsible when it comes to information like that. So it has to give no daylight, not a sliver of daylight. See, I find that odd, that the message across everybody speaking is absolutely consistent. If these were independent minds and these were all independent thoughts, you would have a distribution of opinion. Members would be free to express their distribution of opinion, and on the dot plot, you had one person that was way, way, way below. You have some people that are below the middle of the distribution or the median point, and some that are above. With all the speak that we had, you would have had some distribution of statements, but you didn't. You had a very, very tight distribution. That sounds strategic to me. That sounds like a group of people who are on a private conference call saying, you know what, we can't even tell them the truth. We can't even give them any kind of guidance whatsoever, because the moment we say we think we're near the end, the market's going to rally, and then we're only going to have to raise rates even higher. We need them to stay where they are right now, and we need these guys to stay back. Give them no quarter, give them no daylight. And I think that's what's going on right now. And I think as long as they can maintain that, and the market believes that, I think you have 50 in November, with 25 in December. Okay, big story here on real yields. All of them on Friday hit the year-to-date highs. Look at that, 192, 177, 168, 174. So from the 5 to the 10, you are inverted on real yields as well. Big moves. Well, this shouldn't be a surprise either. All the break-even rates are lower. The 5-year down to 2.14. The 30-year down to 2.05. This was the beginning of the year. You are way below the beginning of the year on inflation expectations right across the board. The 5-year forward at 2.16. We would say that they are well anchoring. Now the question would then become, is this a result of the Fed saying we're pushing rates higher and people believing higher rates will cure inflation? Or is this the result of the market participants saying higher rates are going to put us into a recession? The recession will cure inflation. Which one? You know, in the end, higher interest rates will cure inflation, but will they cure inflation without the recession, or do you need the recession? In other words, is the recession a mediating variable that has to be in place for inflation expectations to come down? So I don't know what's being priced into here, but I'm sure the probability of recession in a lot of investment managers' minds is higher than it was, let's say, 3 months ago, which means they are going to be positioning at the margin. They'll be positioning for that. This is a good number. We had introduced the national financials condition index. This is the adjusted national financial conditions index. We want to see this positive. And we have 0.04 currently. So that is going in the right direction. And to keep that in positive territory, you cannot have the market staging a rally. Because if there's an equity rally, there'll be a bond yield rally as well, because they seem to be perfectly correlated. I shouldn't say perfectly correlated, but so highly correlated now, movements in one mirror movements in the other. And if you get a rally in bonds, you're going to get lowering of yields, which is exactly what the Fed doesn't want. Now, the Fed would allow a market rally if bond yields didn't rally, if bond yields stayed elevated. In other words, bonds did not get a bid. Maybe bonds sold off even more as the market rallied. The Fed might say, we can live with that. Maybe. I don't know. But here's the number to watch. We'll post it every week and we'll see where we get to. But it is peaking in the positive territory now. That's what they want to see. That means that financial conditions, the adjusted, looks at where we are now given the economic situation. What is the stance of monetary policy given the current situation? When it's positive, it means it's tighter than it needs to be given the current economic and financial situations. That's a good thing. What is working against us right now is unemployment insurance or the claims. We get the jobs number on Friday. I don't see, based on the unemployment claims, the initial jobless claims throughout September, that we're going to be printing job losses. I think it's going to be another month of job gains. Just how strong those gains are, we don't know. But here's seasonally adjusted initial claims. September 10th, 208, dropped to 209, dropped to 193. And I said the number we would look for is 300K per week. And if you did that for 4 weeks, you probably would print zero job growth and maybe even negative job growth. But being that it's going in the other direction, I don't know that we're going to get there. 4-week moving average, 222 to 215 to 207. The insured unemployed, this is seasonally adjusted as well, went from 1.4 million, 1.376, a drop of 24,000. Then you have another drop of about 29,000 here. No information on whether they're getting jobs or if they're becoming what are called long-term structurally unemployed, which means they still can't get a job, but they're not unemployed any longer. We look at the insured unemployment rate. It's 1%. So if everybody who was insured got a job, the unemployment rate would go from 3.7 to 2.7. Since they're on unemployment insurance, they are in the labor force. They are counted as part of the unemployed, 3.7% unemployed. 1% of that 3.7 are actually being paid to be unemployed right now. That means 2.7% are not. Okay, some interesting information from the San Francisco Fed. These two came from the same report. This is a different report, and this last one over here is a different report. Link is in the description box below to the San Francisco Fed, where they have all the listing of all of the research reports that they've written up. We had PCE on Friday, and it came in hotter than expected, but I don't think that that was a surprise because we had CPI that came in hotter than expected. PCE usually comes in lower than CPI, but is highly correlated to CPI. CPI is a measure of price levels. The PCE will substitute. If a price of something gets too high, it'll buy more of something else. So the PCE is a consumption expenditure price index, meaning rather than looking at a basket of prices that exist in the economy, let's just look at the change in price of what people actually buy, because I've used this example before. If a steak dinner goes from 39 to 40 bucks, that's price inflation. But if nobody buys that steak dinner for the price for the period of the month, then nobody experienced that price inflation. So PCE is a better measure of the cost of living as opposed to the price level. Well, it'll follow CPI, but lower. It comes in lower because it can shop around, it can substitute, it can do those things, so it comes in lower. The first two charts at the top here, figure 3, this is supply and demand driven contributions to year-over-year headline PCE, and this is contributions to year-over-year core PCE, with the green being supply driven, the yellow is ambiguous, and the blue is demand driven. So if we look at core, just demand-driven inflation on headline, 1.88%, and on core, 1.71%, well below the 2%. Yellow's ambiguous, which means, well, you can make the case that it is supply, you can make the case that it is demand. It's not clear-cut, so it's ambiguous. So let's say we put these two together. You're at about 3.1 on headline. And here you're about 3% on core if we attribute all of the ambiguity to demand. So there is some work that can be done there. Supply driven, 2.92 on headline and 1.89 on core. So you get to 4.85 on core. 1.9 of that 4.85 is supply driven, which probably would respond negatively to interest rate hikes, because as interest rates get hiked, there may be no motivation to invest more in the supply chain at this point in time if you expect a drop in demand, which means these bars may stay at this height, and that means all of this would have to actually show negative numbers if we take the Fed at its word that it's looking at core and core, that's it. Maybe it does consider the components being supply-driven, demand-driven, and the ambiguous. And if it does do that, it might handicap their numbers for this and say, well, we're sitting at 3.2%, but we do know that 1.5% of that 3.2, for argument's sake, is supply-driven. We're only going to break things that don't need to be broken without fixing the very thing that needs to be fixed. And maybe it's an interest rate cut that's needed at this point to fix the supply channel. Maybe they might say that, because we can criticize the policies of the Fed and say, they're making kind of stupid policies at times. But I don't know if we can call the people on the committee stupid. I don't think they're stupid. I think that they have been misguided in the past, but I don't think they're stupid. If the San Francisco Fed is putting this out, they must also be aware that there are some parts of inflation that interest rates are just not going to solve. Down here, this is cyclical and acyclical contributions to core PCE. What does this mean? Cyclical means overall economic conditions. That means that there's some component whose price is sensitive to the overall economic conditions. Acyclical means the price sensitivity is something, the price sensitivity of something is industry specific. 2.42 versus 2.56 on acyclical versus cyclical. So industry specific things. One can think here of autos. Is the auto companies, if you look at vehicle production or vehicle sales, they're already running at recession levels. They're already so low because they just can't make enough of them because they can't get the parts. Ford announced that over the past 2 weeks, I think it was a week ago, that it can't get parts. It's got 85,000 SUVs and trucks just sitting there because, well, it can't deliver them. So that is something that's industry specific. So the price of autos is being held high because of supply issues, and it is acyclical. That's something interest rates are not going to solve. I think they're aware of that. This is really what will respond to what they're doing. This is a troubling one over here. This is the changing components of wage inflation over time. And it looks at, well, if you're going to have wage inflation in this period, what contributes to this wage inflation? And you could see for a long time it was sitting just under 3%. What is contributing to that? Well, last period's wages, that's the dark blue line, that if you had, 100,000 last year, I expect I'll have more than 100,000 this year. That should just be my wage for one more year of experience. The unemployment gap has something to say about that. If you have a very tight unemployment gap, maybe you can negotiate for higher wages. Headline inflation, inflation expectations, and then other items as well. If we look at inflation expectations, there was always some inflation expectation in there, but it wasn't very much. They measured it as a 12% pass-through. That was pre-COVID, 12% pass-through. So if inflation was let's say 1%, it contributed to 0.12 in wage inflation, 12% pass-through on average. Post-COVID, look at the size of these bars now. That's 100% pass-through. That if inflation is 2%, then that full 2% goes on to the expectation that you'd want in your wage increase. So if you say, well, I want 1.5% every year wage increase just for my experience, and if inflation is 2%, you got to add the other 2% on. Whereas back here, if it was 2%, you'd be adding another 0.12% on. So you'd have 1.62 versus 3.5% because of this pass-through. So now they're saying, or at least the numbers are suggesting, that the inflation expectation is now being 100% passed through in wage expectation of what you're going to get the next year. That's a problem. That's what they do not want, because that leads to a wage price spiral. This is a positive feedback loop, and we're going to see another positive feedback loop later on, and it's these positive feedback loops that cause problems. You have to break them because they will continue until something breaks. So if you have 100% pass-through in inflation, it's going to show up in wages. If it shows up in wages, it's going to show up in prices. And if it shows up in prices and you have 100% pass-through, it's going to show up in wages, which is going to show up in prices, which is going to show up in wages. See what I'm doing here? This is a spiral. And that's what they want to avoid, this wage price spiral. So the summation of this is that there is evidence suggesting on this screen from the first three charts that there is a component of inflation, although unwelcome, that interest rates aren't going to fix, that you need some work on the supply channel to fix, and perhaps it's lower interest rates that get that done by promoting more investment. However, you do have wages right now which are displaying the very real possibility of a wage price spiral. And that to the Fed is more important to break than anything else. They do want something to break. They want that to break. And in breaking that, they've said that they're willing to break other things. And last week we saw what misguided policy will do in the UK. Something broke there, and we'll talk about what broke and how it broke. But I do expect more of those things to happen. As you push something and you keep pushing on one thing, because the economy is full of these feedback loops, these positive feedback loops, they're everywhere. You don't know what you're going to break next, but guaranteed the dollar and the central bank hiking policies are going to break something somewhere. You just don't know where it's going to break. But it usually will break where you have these kind of positive feedback loops. Okay, let's look at one of these positive feedback loops. Let's go over to the UK and let's make sense of what happened with the pension funds in the UK. This is the 30-year bond yield. Look at this run up here. A lot of forced selling was going on here. This was not natural. This was a positive feedback loop going on, 4.998% on the 27th, and then you had this drop. This was intervention going on here. And while you were having this intervention, this is on the 28th, the S&P rallied 100 points based on the fact that, hey, governments are willing to step in to backstop markets. Okay, the Fed will do the same thing, and up we go 100 points. I took that opportunity to sell calls on the S&P because intervention is not a good sign. Intervention is not a one-time thing. Intervention has to keep happening. This is not over. This is not over by far. In level 3, CFA, fixed income portfolio management, first two readings, we learned about liability-driven investing and immunization. And I'll give it to you in a very simplified form. The real world is a bit more complicated and nuanced, but I'm going to try to distill it down to the core story of what happened here so that you'll understand. There is, whenever something like this happens, there's always the stories coming out that, there were a bunch of people gambling with people's pension money. No, they weren't. They were specifically not gambling. And that's the problem, that if they were gambling, maybe this wouldn't have happened. If you allowed them to gamble, maybe this wouldn't have happened. But they weren't gambling. It was just the nature of these positive feedback loops. So let's take pension funds. They have assets and liabilities. Liabilities are the future payments they have to pay pensioners. Assets, the money that comes into the pension fund from payroll deduction or from the company sponsor or from government. If it's a government pension plan that says, here are the assets to meet those future liabilities. And it's up to the pension fund to manage those assets to grow to the point where they can meet these liabilities. So at any point in time, to determine where they stand, you can look at the market value of the assets and you can compare that with the present value of all of those future payments. Those are benefit obligations. So that's the pension benefit obligation. So you're looking at the market value of the assets, what you have today, versus the present value of the pension benefit obligations. And you want to, if they're equal, that's a good thing. And if you can grow the assets at the same rate as the liabilities grow, that's a good thing. Well, these are both interest rate sensitive. Your liabilities are interest rate sensitive. Your assets are going to be interest rate sensitive as well. So there is something called immunization, meaning that, okay, listen, we may not have the amount of assets we need to meet the liabilities, but we don't want that to get worse. So we don't want changes in interest rates to make things worse. So let's set up our portfolio such that if there are any changes in interest rates, the value of the assets will change by the same amount as the value of the liabilities. So that if we have a funding gap, it doesn't get worse. Well, to do that, you're going to have to match on interest rate sensitivity. Duration is a sensitivity to rates. Duration measures the percentage change in the present value of whatever it is, the assets or the liabilities, for a change in rates. and we call it duration. It sounds like a length of time, but duration is not a length of time. When we talk about duration, whether it be modified duration or effective duration, duration is a sensitivity. Much like for equities, beta is a sensitivity. It tells us how sensitive a stock is to changes in the movement of the market. This tells us how sensitive our assets are to changes in interest rates. So we'll have a duration measure for our assets, and we'll have a duration measure for our liabilities. Now, duration is related to the length of time to maturity. The longer the length of time to maturity is, the more sensitive it is to changes in interest rates. Let me give you a very quick tutorial on that. Let's say that you're expecting $1 in 1 year, or expecting $1 in 10 years. Which one will have the lower present value? If interest rates change, which one will change by more? This one will, because you're discounting this at 1 plus r to the power of 10. So if interest rates change a little, compounding it 10 times results in a large change in the present value. So the duration, or the sensitivity of the liabilities to changes in interest rates, will be very high, because they have much longer, the liabilities much longer than the longest duration asset. And when I say duration, I should say the longest maturity, not to mix up words. So sometimes the maturity of your liabilities can be up to 50 years, 60 years, which is longer than the longest duration, longest maturity asset you could buy. So it's quite common that the duration of the assets is less than the duration of the liabilities. But we have the market value of each and the present value, so we usually look at it in terms of what's called a basis point value. You'll take the market value of the assets, you'll multiply by the duration, and you'll multiply by 0.0001 to get a basis point. You'll do the same thing with the liabilities, and you would like these two to be equal. Typically they're not, because the duration of the assets is much lower than the duration of the liabilities. So you would need the market value of the assets to be so much larger than the present value of the liabilities. That's typically not the case. Therefore, you have to add duration. You have to add interest rate sensitivity somehow to your assets. You can use swaps, or you can use futures. These are derivatives. Nothing wrong with that. That's exactly what you should do. Now, if we make the accusation that these pension funds were playing with pensioner money, that would be the case if the managers of the pension fund said, you know, we think interest rates are going to go up, which means the value of the liabilities are going to drop. So let's not add duration. Let's take an active position on interest rates and not add duration. Which means this probably wouldn't have happened, or it would have happened to a lesser degree by taking an active position. But now you are playing with pensioner money because you're making a bet. Well, what if you're wrong? What if you're wrong and rates went the other way, and the funding gap between the assets and liabilities actually got wider? You're out of a job. So the safest thing to do is take the most passive stance, which is to fully immunize with no active position, knowing that if rates really go up, while your assets and liabilities, or while your liabilities would be immunized from interest rate changes, in the value of liabilities would be from interest rate changes, by the change in the assets, you have derivatives which are subject to margin calls. And you're going to get margin calls because if you're adding duration, you're long the futures contracts. If rates are going way up, the value of the underlying is going way down, the value of your futures is dropping. Margin call, margin call, margin call. And that's the problem that happened. As yields increased, the market value of the assets dropped, which means in the market value of the assets, these are the underlying of the derivatives. Therefore, margin calls are required. So in this particular case, duration matching did not fail. The immunization program worked exactly as it's supposed to work, but whenever you introduce derivatives, we learned this in level 3, liquidity issues. It's liquidity that failed because to meet a margin call, you need cash. Well, they didn't have enough cash sitting around. Normally, rates move slow enough such that cash naturally appears in your portfolio in two ways. The income from the assets that you hold, and every week or every 2 weeks or every month, all the deductions from payrolls for your pension contribution that come into the pension fund every 2 weeks. So there's usually a natural river of liquidity to meet margin calls on slow-moving markets. But when you have this, and then you have this, well, that creates margin calls. Margin calls require selling, which creates this, which triggers more margin call, which requires selling, which triggers more margin calls, which requires selling, more margin calls, selling, more margin calls, until somebody says, we'll step in. Because that's the only way to stop a positive feedback loop, is to break the loop. Otherwise, that selling would have continued and continued, because it would have been margin call after margin call, unless these pension funds could have secured lines of credit very quickly to stop this. But who's going to step in on a line of credit in a positive feedback loop? Everyone would have to get credit all at the same time, but there's only one person, only one lender of last resort in a situation like that, and that's the central bank. That's what happened. Now, this positive feedback loop, I don't think is done, and this is not the only positive feedback loop that exists in an economy. All it takes is for something to start the ball rolling, and then you have this cascading process that happens until somebody steps in, usually the central bank, to break it. Otherwise, things could get very, very bad. Okay, let's look at credit spreads. As we see down here, the change week over week, they're starting to come along for the ride now. The investment grade at 1.68 has put in a high for the year. This is just the spread, the OAS. And triple C at 12.89 has put in a high for the year on September 30th. But the rest are all sitting at July 5th. High grade, we call this investment grade. This is high yield. This is the yield, and this was the OAS. The chart up here, this is all OAS. If you add it to the appropriate treasury yield, you get the yield on the security itself. There are two ETFs we can look at here, one that tracks investment grade, LQD, and one that tracks high yield, HYG. Short interest on investment grade, 16.64. Compare that with the short interest on high yield at 43.67. 2.95% dividend yield on a trailing basis. It pays monthly. HYG has 5.19% on a trailing basis. It pays monthly. Once we start seeing high yield get to about 800 basis points, that's usually an extreme point. 200 on investment grade represent probably very good entry points. We're at 550. High of the year was 5.99. I don't know that I would be too interested in HYG until I saw it breach 5.99, especially with that short interest, 43.67. On the other hand, any good news at all that causes a rally in high yield bonds also would be news that would cause a rally in the market. So if you think that, well, we're going to get a relief rally soon, these may go along for the ride, and if they do, with 43.67 short interest, you might get an oversized rally in HYG. You are getting paid to be there, which isn't too bad. This is interesting over here. This is an ETF, BKLN. It's a senior loan ETF, leveraged loans. What makes these sort of interesting is they have a floating rate coupon. They tend to be loans to issuers who just aren't capital market ready, or the issue is too small for capital markets. Got a fairly large short interest as well, 40.75. Dividend yield 3.79. Because they're probably good borrowers as far as credit quality goes. They're just small. So 3.79 is better than a 2.95. This would be considered an alt investment because it is bank loans as opposed to publicly traded debt. The underlying of these are not publicly traded, but you can get access to it through a publicly traded vehicle. 3.79 versus 2.95, you probably have comparable credit quality. You have floating rate as opposed to fixed rate, and probably, as I said, higher credit quality than the high yield. But as far as short interest goes, it's got a fairly high short interest ratio. Okay, let's turn to the housing market and the real estate market. For those of you who have the applied series, the real estate sector study will be up in the coming week. Part one of it. It's a long one. It's in a couple of parts. It's a long one because it's the one I have the single most experience with. So it's pretty much everything I know. Let's look at mortgage rates. 6.79 versus 6.7 the week before. That's not bad. It did at one point breach 7%, closing at 7.08. FHA closing at 7 at one point, settling at 6.5 versus 6.25 the week before. Some interesting data on the housing front. Housing price index month over month for July down 0.6%. And when you look at the report, there are 9 divisions that they report on. 8 of the 9 divisions were showing price decreases month over month. It's the first price decrease month over month since May of 2020. The Case-Shiller month over month for July came in at negative 0.84. That's a 20-city composite. These are both repeat sales indexes. So they're for existing homes, not new homes. Look at new home sales down here, up 28.8% in August, month over month. Run rate of 685,000 per year versus 461,000 per year in July. Median price 436, average price 521. Inventory of new homes sitting at 461,000, which is an 8.1 month supply. That's interesting, isn't it? Up 28.8%. That's a big jump. And it could be that, when you're looking at existing homes, it is what it is. That is the home. There's not a lot that you can do other than negotiate on price. But when you're looking for a new home, there's a lot you can do in terms of the features that you add on to the house to manage the price of the house. You can say, look, I'm in the market for a $500,000 house, but I'm not finding a $500,000 house that I like. Maybe a builder can build a $500,000 house if I say, well, you know what, I don't need a finished basement. I can do that in a couple of years myself. When prices calm down, I can finish the basement myself. I don't need granite countertops, maybe just some a basic kitchen, and I'll just remodel the kitchen later on. And you just build your house with features that make sense to target the price that you want, to say, look, give me a shell, give me something I can work with, and then I'll add everything else as it goes on. I'll do my own home improvement later on. I don't need a fence, I don't need a back deck, I don't need a finished basement, and you can negotiate that. So maybe more people decided, well, we still need a home, but the existing homes don't make a lot of sense. Let's go into new homes and let's see if we can go down that feature list and get the price to where we want that price to be. Builders do have that advantage in that they can do that. The other advantage builders have that individuals don't have is builders have a psychological distance from the price. An individual is usually psychologically tied to a specific price. They're anchored to a price. Businesses are more willing to make fast decisions on price to clear inventory. They make more rational decisions in that sense about what's optimal given the point in time that they're in, whereas some individuals are hesitant to drop their price. And we're seeing that in this region as well, is people who are looking for a home saying, well, there's not a lot of supply. And what's out there, agents are saying the sellers still haven't come to terms with the fact that the price they want is gone, that those prices are from 6 months ago, those prices are gone. And those that are unwilling to lower their price simply don't go onto the market. So there's still a lack of supply, but new home builders don't have that psychological tie. Mortgage applications down 3.7% for the week ending September 23rd. Refis are down 10.9%. Purchases down 0.4%. Pending home sales. This tells a different story than new home sales, because pending home sales is a house in the process of being sold, which is existing homes, down 24.2% during the month of August. New home sales up 28.8%, pending home sales down 24.2%. negative 2% month over month. So, you know, a bit of a mixed story going on here. I like this number because new home sales, these are coming from builders. If they're coming from builders, maybe it's that psychological distance they have from the price and the ability to build a house to the price that they want, to try to target the price they want. Whereas an existing home, if you walk into my home and say, well, how much without a finished basement? I would say, well, I'm not going to unfinish the basement for you. It is what it is. I'm not going to change the granite countertop. I'm not going to change the kitchen cupboards. There's nothing that can be changed. It is what it is. But if you walk 2 subdivisions over to where a builder is building and you say, hey, this house that you're building, can we make some changes on the interior? You're probably not going to get much on the footprint because they have 5 or 6 designs they work from, but it's all of the feature list inside that you have a lot of play with. The fixtures that you use, the appliance allowance that you're allowed, you know, if you say, look, I have my own appliances, I don't need your appliance allowance. There's so much you can do, right? So maybe, you know, the home builders will see, you know, limited downside because of that. What do I have here? I have 3 things that we're looking at. ETF IEF, which tracks the 7 to 10 year treasury. I have the MBB, which is an ETF for mortgage-backed securities, and I have the IYR, which is an ETF for real estate, for REITs. And the real estate ETF is going to be very highly correlated with both the 10-year and the MBS, which are correlated together. You can see how the blue and the orange lines basically move together with a spread. You have the spread between them in terms of price. One will have a lower price, but they tend to move together. Real estate cycles with them, is highly correlated with them, but with a higher beta. So as you have your moves downwards, you have your moves downwards. Here we went this way, there you go that way, then you have your move down, you have a slow move up, then you have your move down, then you have this going on here. Notice that big drop over here. There's your big drop over here. It's correlated very closely with where mortgage-backed securities are. It's probably most highly correlated with the 10-year yield, which is why I put the 7 to 10-year bond ETF in there. And it's not so much the level of the 10-year that helps explain movements in IYR, but it's the changes in the yield of the 10-year that help explain changes in the price of IYR. So I put this up here because on the next screen we're going to go into a little bit more detail with IYR. Short interest on that right now is 33.15. Short interest on MBB really low, 1.15, and short interest on IEF sitting at 1.37. So we do have some short interest in here. And depending on what the dividend yield of it is, the dividend yield on real estate tends to be a mean reverting series. So if you can determine the mean reverting level for a real estate portfolio, when it gets to extremes, in other words, too low or too high by a certain number of standard deviations, that's usually entry and exit points. Okay, I've got the IYR. Both of these are called performance charts. They both start at a common 0% return. These are total return charts. I have the IYR up against the SPY for 2 periods of time. This first period of time is July 2003 to December 2004. So I tried to pick a point in time where the market was near a top, as opposed to trying to find the most opportune time. I tried to find just that period of time. You can see how SPY has dropped. This is 40%, somewhere just around 50%. And it did take almost 2 years for SPY to get to that level. And then you had this slow recovery out of it, which is what market participants now, it tends to be the consensus, is that this bear market and subsequent next phase of the bull market will look like slow growth out of it. Look at IYR, on the other hand, just outperforming Over the 3.5-year period, SPY had a negative 10, almost negative 11% return. That's not compounded, that's over the 3.5 years. 116.19 on IYR, which translates to almost a 24% per year compounded annual growth rate. That's total return. That's price return and dividends as well. If we look at this one over here, this is January 2nd, 2009. That's the first day of 2009 all the way to the last day of 2013, the 4-year period after the GFC. And you have the markets bottomed around March, I think it was March 9th. It was a Monday. I remember this day very specifically because the market rallied that morning and never looked back. You had what you see here. If you saw the chart before, it was doing this. You had this V-shaped recovery in the middle of all that because you had a lot of central bank action, a lot of treasury action, but that morning specifically, Citigroup came out, gave guidance for the quarter, said they're going to be profitable for the quarter, and that was all that was needed, and that was it. That was the end of it. It ended that day, and everything went up from there. So the S&P did rally over that period of time, 118.84, which is roughly around, where are we here? This was a 3.5-year period. This is a 4-year period. 20.6% compounded annual growth rate. Look at IYR. Look at the outperformance that you had in that period of time. Ended in the same place, mind you, but look at the outperformance that you had coming out of that recession. The outperformance you had coming out of that recession here. And that's because the sensitivity of real estate to interest rates and to economic activity. In recessions, interest rates get cut, present value of all those cash flows increase. Also, as interest rates get cut and the economy finds a bottom and starts to get better, equities will anticipate a better economic future and rally ahead of that. Well, REITs are very sensitive to economic performance as well. So there are two reasons why they would rally. Going into a recession, there are two reasons why they sell off. Interest rates tend to get raised before a recession, which sends real estate prices, or at least the present value of all those cash flows down. And in anticipation of the economic recession, it sends the growth rate in those cash flows down as well, which is a double hit. So real estate tends to have these nice big cycles coming out of recessions. They tend to do very well. Okay, I know you're thinking, come on, man, look what you're doing to the screen. Nobody can follow that. That's a lot of writing. It is a lot of writing, but I'm going to break it down for you nice and easy. The first thing we're going to do is we're going to pay attention to this stuff that's written in here. Okay? This was the June low. Here we are now. We've breached the June low. The SPX June low was 36.74. The September low, we closed at 35.82. That is 2.43% below the June low. And I said last week when we had a double bottom, I said little breaches of the bottom aren't really going to be a big deal. A close below 2% below the June low is potentially a big deal. We're 2.43% below and on increasing volume. It wouldn't be so bad if this were lower volume. If it had breached the low and closed below 359 on lower volume, that's still a question mark, but it's on higher volume and it's down below 359, and that happened near the end of the day. You know, I don't know that it's convincing enough to signal a new leg down, but it is threatening enough to signal a new leg down. At this level here at 358.65, the index is currently now trading at 15.56 times forward earnings. Forward earnings still coming in at 230.32, and this is forward 4-quarter earnings. We're now down 25.25% from the high, and it has been 270 days since the high. And we're going to compare, this is depth, this is duration. We're going to compare depth and duration with the last two significant sell-offs. And we're going to see that this one has a different flavor altogether, so I don't know what to expect. The September low happened as the orange writing. You'll see a bunch of orange writing on the screen. Those are all the federal funds rate at that time. So the September low happened at 3.25. The June low happened at a lower rate. So we are raising rates into this sell-off. Let's go back to 09, 07, 08, 09. October 9th, 2007, the SPX printed its high for that cycle at 1565.15. On March 9th, 2009, it printed its low of 676.53. That is a drop of 56.78%, and it was 516 days top to bottom. Compare that with where we're now. We're down 25.25, which is less than half the depth, and 270 days, which is just a little over half the duration. At the peak, the Fed funds rate was 4.76. At the bottom, it was 0.18. So the market spent 516 days going down as the Fed funds rate was going down. Let's go over to 2000. March 24th, 2000, we had 1527.46 on the S&P, printed a high for that cycle, and hit a bottom on October 9th, 2002 of 776.76. That's a 49% drop in the SPX. 930 days top to bottom. And again, compare that with this, down 25.25 versus, well, 25% versus 50. We're half the way there. 270 days versus 930 days top to bottom, less than half the duration. So we are less than half the depth of the last two, and just a little over half and way below half the duration of the previous two. Now on this one, on March 3rd, 2000, the federal funds rate was 5.85 because it peaked in March. And when it bottomed in September of 2002, it was down to 1.75. So you have two patterns that were going on here and here. Something broke, then you got rate cuts. So you had the Fed funds rate rising, something broke, then you had rate cuts. But here we have something different. We have rate hikes going on while the market is selling off, not rate cuts. We're going the other way. Something broke, then you got rate cuts. Up here, something broke, then you got rate cuts. And I give you some items here. We had a tech bubble that burst and 9/11 happened at the same time. Here you had a housing market that was unsustainable. You had low credit standards and a high level of leverage. And again, something broke, then you had rate cuts. So what has to happen here for rate cuts? Something has to break. However, we rallied into the rate hikes both these times. The market was, the Fed was hiking rates and the equity markets were rallying until something broke, and then you had rate cuts under both these situations. In the situation we're in right now, nothing, the market is breaking because we have rate cuts, but nothing really has broken. You can say, well, inflation has broken, but the market is the rates are going up at this point into a sell-off. That is a different flavor than the last two. Markets rallied as rates rose until something broke. And here, rates will rise until something breaks. Something will break. We've already seen it in the UK, that you had the BOE have to step in and buy 30-year gilts to stop the bleeding that was happening in the pension fund industry. Otherwise, that would have continued. The world is full of these positive feedback loops. Something somewhere is going to break. That is not a statement saying that's saying nothing. It's saying something specifically. I don't know what's going to break. The certainty is something's gonna break. You just don't know what it is, because all of these positive feedback loops, you don't know they exist until they start that positive feedback process. On this cycle here, we hit a high of 47.96 on January 3rd, Fed funds rate 0.08. And as the Fed funds rate has gone from 0.08 to 3.25, the market has gone down. That is different than here and different than here. Both of them are different. In both of these, preceding these, the rates were rising while the market was rising. In both of these. And then something broke and then rates got cut. We're doing it sort of in reverse now. But just to kind of put things in a little bit of a perspective, if we want to compare it to the last recessions, and if we think that behavior repeats, and this is why technical analysis, at least the argument is technical analysis has power, because psychology is the same. The psychology of a sell-off will have discernible patterns that you can see. And if we think about those discernible patterns, negative 56, negative 49, only negative 25%. 516 days top to bottom, 930 days top to bottom. We're only 270 days in, which means if you want to be comparable, you would say, well, we're looking at another 25% over the next 250 to 300 days, and that makes this comparable with this and with this on a, repeatable psychological basis. Okay, so if we accept that argument from the last screen, or that line of reasoning from the last screen, that will put us at a market bottom sometime in June of 23 at 2400. I don't know, from where I stand right now, I can't quite get there. I don't know where we're going. Nobody knows. Maybe we will get there. I don't know. All we can do is say, well, from where I stand right now, here's the range of possibilities. So we may have, well, we could go this way, this way, this way, or this way. And as the information unfolds, we might decide we're on this path, or we might decide we're here or we're here. And once we're here, we may have different possibilities, and we decide that we're here. And from here, there may be different possibilities. So the idea of saying, here's where we'll be next year, that is hard to do unless you have a benign environment in terms of volatility, where you have much more predictability. The lower the volatility, the more stable growth is, the more visibility you have out for a couple of quarters, barring any exogenous shock, because that by itself is not forecastable in the least. So the most you can do is say, okay, well, let me be aware of the scenarios that are available, and as the market unfolds, I'll determine what my stance is going to be, whether it's going to be net negative, net positive, or neutral. So let's look at where we are now, the Q3 2022 to Q2 23. This is the forward 4-quarter earnings estimate, still sitting at 230.32. And we're about to go into Q3 2022. So this is going to drop off, and the forward 4 will be Q4 22 to Q3 23. And let's just leave it at that for now. So we're sitting at 230.32 for the next 4, which would put us at 15.56 on the market multiple. If we look at the next technical or fundamental level we get to, there is both technical and fundamental support for 3,400. 3,400 is the last peak we got to on the index before the March pandemic sell-off, which is 4.76 below what the closing was on Friday. That would put us, if we accept this number here, at a forward multiple of 14.76. But let's just go ahead and say, you know what, we're in the Q3 earnings month now, which is October. Let's drop that off and look at the next 4 quarters. And let's say that we don't have growth. It's not even flat, but let's say 10% lower. 10% is just a subjective number. You could easily say 9.6 or 11.5 or 15, right? But I'm just taking a 10% just to sort of fill out the range of possibilities. 207.32, and if you hold 3,400, that would put us at 16.64, which is in line with the 10-year average on the forward multiple. But let's draw out a line, and let's say that's 16.5, which is the 10-year average. And we've been above the 10-year average, and we're at 15.56. Now, you never just go down to the average and then say, okay, there we are. These things oscillate, right? So you have overshoots and undershoots. So it's the undershoot that we have to be concerned with, because we might say, well, 16 times, that makes sense. And this is 10% down, that makes sense. That's a nice entry point, but the market may overshoot, which means you could have waited and perhaps got a better entry point. Or when you added this particular stance, which was a long position, you might have wanted to add a short position somewhere or increase your short position so that you are net neutral. Depends on how you look at where we're going. So let's go a little bit further and overshoot. Let's go down to 3,000. Given the 10% pullback in earnings, that would put us at 14.5 times forward earnings, which is definitely an undershoot. If we think the long term is 16.5, we've come down from 20 to 19 to 18 all the way to 16.5. Well, what says we're going to stop at 16.5, right? You know what psychology can do. It can take you further than you want to go. So 14.47. Getting to 2,400 is not done in one step. As I say down here, there will be rallies because you don't get there all in one move. You may believe that by June 23, 2,400 is the appropriate ending point, but on the way down, you're going to have these sort of things going on, these kind of rallies. Being short here because you think, well, 2,400 is the right number to be at, and we're at 3,500, so I'm going to go all short. You get one of these, it will crush you. So you have to be prepared for these rallies, and right now you have a short interest on SPY of 19.69. Short interests have been growing on a number of ETFs, on a number of stocks. And at 19.69, it's not the highest short interest, but it is an elevated short interest from where we were at 16%, I think, a week ago. There's a higher short interest position. These are positive feedback loops as well. That short interest is a positive feedback loop, because if you get any kind of rally that starts this process on any kind of good fundamental news, it will start a short covering buying, which will push the market up, which will then cause more short covering buying, which will push the market up, and you'll get that spiral upwards. So you have to be careful about this short interest position. If it were sitting at 2%, I would say, maybe you might get some fundamental news, good news, and you might get a rally out of that, but I don't know that you're going to get a lot of the short positions attempting to cover, thereby giving it more legs than what it really has to. So being that it's 20%, it's high enough to pay attention to. There are always rallies on the way down. Nothing is ever a straight line. Much as, on the way up, you have rallies and pullbacks. You have rallies and pullbacks, rallies and pullbacks. You have rallies and pullbacks. There it is again. You have rallies. Here you go. Pullback, rally, pullback, rally. It's never one straight direction. You have to determine what the primary direction is, and you would use the offsets to then modify your position. And you'll trade in the position that you think you're headed in. So here was probably a good idea to be short. In this August rally that we had before Jackson Hole, I was net short as well because I thought that was ridiculous, and we sold off. The 100-point rally we had on the 28th, when the Bank of England stepped in to support the gilt market, I thought was unwarranted given where we were. What are we doing? Are we going to do another July-August thing? After everything that's been said, is that what we're going to do? But I figured, well, that's just a sentiment spillover from England right now. That's unwarranted. So I sold 382 calls and 378 calls on those rallies. I am taking long positions, early long positions, in places I want to be. In metals and mining, in the auto industry, in real estate, and in certain industrials like Alcoa. I am taking early positions because I think that a lot of the damage has been done in those particular industries. They're trading at very, very low multiples, and in the REIT space, apartment buildings have been sold off to ridiculous levels at this point, that if you're not buying apartment buildings, you're missing, I think, a big step in, because rents aren't going anywhere. They're not going down. They're elevated, they're up, but guess what? Those apartment buildings were bought at a certain price years ago, and now rents are where they are. So the yield on those assets is extremely high, given the price that they used to have. So I've been stepping into those, but at the same time, I'm using rallies not to sell any of the long positions I have at a profit, but to add any negative delta dollar beta. You know, that's my favorite measure, DDB. But to add any negative to my portfolio to bring it more into neutral on any rally. There will be rallies. Don't look at these forecasts when someone says, oh, we're going to 24, we're going to 3,000, and think, I better get short and sell everything. Use rallies to do that. There will be rallies. Maybe we'll sell all the way down to 34 before rallying back up to 36 or 37, maybe, but there will be rallies. So you use the sell-offs to selectively add those that you think are going to hold up well, or that are probably already near their particular bottom. You know, the market will do this, but the market is made up of sectors. Some sectors will do this, other sectors will do this, some sectors do this. Take healthcare. There's a sector that tends to do this, and healthcare is a big sector in the US. Smaller sectors in places like Canada, but a big sector in the US. And it tends to be less volatile, hardly volatile at all compared to the rest of the market. So there are sectors you can go into and say, I'll pick this, I'll pick that, I'll pick this, and on the next rally up, I will use the broad market to add my negative positioning until we're through this. This is a time for active management more than any other time. I don't think that I've ever been more active in the market than I have in the last 6 months. Well, actually, that's not true. After the pandemic and the central bank stepped in and did what they did, I was extremely active. And then you're passive for a while. All through the teens, I was mostly passive. There were times where I wouldn't even look at the market for 3-4 days in a row because nothing was going on. Well, every day there's something going on, so you do have to be active. I'm not a day trader. I'm just an active trader, and I am positioning my portfolio to try to minimize the impact that is going to happen until I see green lights up ahead, and I don't see them yet. I'll see green lights when the Fed pauses. When the Fed pauses, that's when markets will begin to stabilize. I believe they're closer to the end of the rate hiking cycle than what they're letting the market think, because, as I said at the beginning, they can't even let the market think that they're at the end or near the end. Even if they believe they're near the end, they can't let you believe it, because you have shown yourself unwilling to act with restraint. They can't trust you with that information. You know, you don't store the candy in the kid's closet. You can't trust them with it. So it's behind lock and key now. So that's, when I'm thinking about where we're going, okay, well, 24, maybe we get to 24. I don't know, but on the way to 24, I know we're not going in a straight line. I know that as we go down, there'll be individual names that are worth picking up. And as we rally, that's where I'll add some negative DDB. And as we go down, the first thing I'll do is I'll start decreasing my negative positioning, then I'll add more. So I'll be net long near the bottom. You're never going to time anything. If you don't want to lose a single penny, you're in the wrong place. You're in the wrong place. What you need to do is stop listening to all these YouTube videos, stop listening to people like me, and head down to your bank and ask for a 30-day term deposit or a 1-year GIC, and you will get a guaranteed nominal return. You may not beat inflation, but you'll get a nominal return, And if you don't even think about inflation, or you don't think in terms of real dollars, you won't lose a dollar. But you are in the market putting your money in harm's way. There is harm, always harm, but with harm comes reward. And the big dollars are made in periods like this. It's in when you buy and how you buy. When the market rallies, all you're doing is you're just taking the profits you've already set up. But now is the time where you set up, and you got to think that, well, if I buy something, maybe there's another 10% down. Maybe there's another 20. So think about that. I'm going to buy something at $80. Maybe there's 20% down. Can I live with a $16 move down? And if you can't, say, well, I'll buy 10% of my position at $80. And if it gets to 75, maybe I'll add another 10% and I'll sell 77.50 calls. And you can roll your calls down so that you minimize the downside, but you're never going to buy right at the bottom. You're never going to sell right at the top. The best you can do is average into a bottom and average out of a top. And that's, when I say that I'm buying this and buying that, you could always say, well, if you think there's more downside, why don't you just wait? Well, I don't know if there's more downside. I don't know. Nobody really knows. I suspect that there is, and I suspect I'll have a better buying opportunity to add the next little bit. And because I suspect that there's some downside, I will use every rally to add my negative positions. But I'm not going to add negative positions after a sell-off. At that point, I would say, look, my portfolio is going to lose value over the next little while till we find the next bottom, and that is the game that I've chosen to play. If I've chosen to play baseball and it's the bottom of the third and I'm down by 3 runs, would I just say, okay, well, that's it, let's just cut our losses and walk away? No, that's the game I chose to play. There'll be times where I'm losing and there'll be times where I'm winning. I'll win some games, I'll lose some games, right? This is where we are. This is what the market is that your money is in harm's way, but you have to psychologically distance yourself from your money, and you have to look at your portfolio as a whole as opposed to each position, and you have to tactically move in and out of exposure. You don't add more and more negative positions on the way down. You reduce your negative positions and you start looking for long positions, because there will be rallies. Patience and discipline. That's what wins this game. Patience and discipline. And of course, knowledge and experience. There are 4 legs for you. All right, let's look at the week ahead. Before we look at the week ahead, let's just do a tour of currencies here. This is the U.S. against the Canadian. The U.S. beat the Canadian. This is the last 5 days. U.S. beat the Canadian by almost 2%. And the U.S. against the peso, U.S. lost against the peso 0.32. Peso, the outperformer again. Nice, strong little guy. At the beginning of the week, it looked like it was going to track along with the Canadian, so I added more to my peso position and my Canadian position. Did okay on the peso, did not do okay on the Canadian. In fact, I'm thinking of switching my Canadian position all the way to the peso to hedge out my US dollar exposure. I don't need to hedge back into Canadian dollars. I'll hedge into pesos. I'm actually thinking of doing that because, my God, this thing just keeps performing nicely. You know what it's going to do? I will do that, and it will be the weakest one on the... I can cause the peso to crash. I know I can. All I have to do is use it as my hedging currency, and I'll be screwed. Actually, I probably wouldn't switch because I do have U.S. exposure, and I live in Canada, so hedging out with U.S. CAD puts me in a neutral position as far as the currency. I'm neither gaining nor losing. I'm just scratching my head thinking, where's the bottom on the Canadian here? I mean, at some point, we have to say, come on. The currency issue is becoming a bigger and bigger issue, and it is one with a whole bunch of positive feedback loops. I don't think that the British pound problem is over, by the way. One of the interesting things that I've uncovered is the nature of the mortgage market in the UK. A lot more shorter-term mortgage terms than in the US. So in the UK, you'll have a lot of 3-year or 5-year mortgages. not that you're trying to pay your house off in 3 or 5 years, is that you're getting a 25-year mortgage and you're locking in a rate for 3 years, and then you'll renegotiate your mortgage in 3 years or 5 years. And there is apparently a whole bunch of these mortgages that need to be renegotiated next year, and a bunch of them that reset on the 1st of January, a bunch of adjustable rates that reset on the 1st. So seen in that light, when you have the tax cuts that were implemented in the UK, which I think is the wrong time for tax cuts, maybe the thinking was all of these, the cost of living in terms of housing is going to increase significantly when a lot of these 2% mortgages start resetting to 5 and 6%. That if we give tax cuts and implement them now, it'll be enough money for the homeowners to then meet the increased interest expense that they'll have. Maybe that was the thinking behind it, is that it was anticipatory of the stress that households will have when all of these mortgage rates reset. But you could have done something with the tax policy specifically tied to mortgages. Either way, what's done is what's done, and they don't appear to be backing off, so I don't think that's done. Here's the growing issue with the US dollar that we have to watch. US dollar is getting stronger, so they can import deflation. And they're exporting inflation. So let's take our business for a second, our CFA business. We were priced in Canadian dollars. Since we were purchased by an American company, they converted us to US dollars at the exchange rate at that time, such that there was no difference between, on the day that they converted it, there should have been no difference between somebody paying in Canadian dollars and that same person paying in American dollars by converting. There should have been no difference in that respect, and somebody in the US would see no difference at all because it's currently in US dollars. But as currencies are dropping and the US dollar is getting stronger every day, our subscriptions are getting more expensive for Canadians every single day. And the $1,000 fee or the $700 fee you pay for CFAI is getting more expensive in Canadian dollars. That's what we mean by importing inflation. As the US dollar gets stronger, the price of that thing in Canadian dollars gets stronger and stronger, or higher and higher every day. You're importing inflation right when the Canadian Central Bank wants to lower inflation. So the lower the value of the Canadian dollar, the harder the fight is, because you're now importing inflation and exporting deflation because our exports are getting super cheap. Especially for Americans, they can import deflation and they're exporting inflation, and we are now importing inflation. So what's that going to cause the central bank to do? It's going to raise rates by more than what the anticipation was. And raising rates in hopes of strengthening the dollar. A strengthening dollar means that we can now start importing deflation. Well, every central bank around the world is engaged in that. When you have the US dollar going in one direction and one direction only, all other countries are saying, you're making our inflation fight even harder because most commodities globally are priced in US dollars. So if you have the price of energy in US dollars that is stable, while other currencies are dropping, the price of energy in other countries is increasing. The price of food in other countries is increasing. The price of any traded good, because they're usually denominated, most trade contracts are set in US dollars, not all, but most are set in US dollars. Countries that are importing are now importing inflation, and the central bank has to go even further and raise rates even more. And if they do that, they will appreciate against the US dollar. The US dollar will depreciate, but what is the US dollar going to be doing at that point in time? Importing inflation, which means they're going to have to raise rates, and well, there you go. You can see the positive feedback loop that is going on there. And positive feedback loops continue until something snaps, until something breaks. So the post I had on LinkedIn last week that said something somewhere is going to break, yes, that's what we have to look for. Where? You can't forecast that. Nobody knows where it's going to break, but something somewhere is going to break. The message there is try to be careful about being completely on one side of the market or another. Because if something breaks and you're not on the right side, that can get unpleasant. And I don't know what the right side is going to be. I just know that this is causing stresses. I can see it here in Canada. I can see it in the things that I would normally look at in terms of pricing. And I can see that once you convert Canadian into American, things are far more expensive now than they were 2 months ago, even though the US price hasn't changed. Just because of the currency, the Canadian version of that price has changed. So we're looking at, CFA enrollment, and we have the results coming out. And one of the things we do is we start thinking, well, what's the conversion rate? How many people do we think that pass will then move on to the next level? And we have headwinds. You have headwinds in Europe. You have headwinds with the currency. As each day goes by, it becomes more and more and more expensive, even though it's still the same price to pay CFAI for the exam. In every currency other than the US, it is becoming more and more expensive. That's adding to that inflationary pressure. And if you have to part with more of your currency to pay for the same thing, you have less of your currency to spend on other things in the economy. It does take away from the retail sales and the purchasing power and the disposable income in an economy when you have to buy things in another currency and your currency is depreciating a lot. I don't know where it's going to break. I would say that to ignore the currency market now, to ignore the strength of the US dollar now would be a mistake. But I can't tell you where to look. I don't know. I don't know what's going to break or where it's going to break, but we have to be prepared for something somewhere breaking. All right, let's look at our calendar for the week. Lots of Fed speak. And I don't know that there are some important data points coming out. I don't know that any of them really have the importance that they would typically have when we're in a situation like we are right now. I think the only really things that matter is what are central bankers saying? What's the employment situation look like? And do we have any insight into inflation and prices? And then on an international scale, has anything broken today? And if nothing is broken today, okay, we're good for the day. So what do we have here? Let's start the week with some Fed speak. And then we have the S&P Global Manufacturing PMI at 9:45 and ISM at 10. And I've already explained the difference between these two and why S&P feels that they have a better number is because they ask questions of companies that are also not members of ISM. This is just a members only sort of report, but it tends to be the bigger, more important one. Construction spending, the number we're looking here on the PMIs is 50. I think ISM says 46. They have a number of 46. Anything above 46 is expansion, even though it's a diffusion index, which should have 50 above or 50 below. I think S&P uses the 50 as the cutoff. ISM uses 46. Construction spending. What else do we have here? More Fed speak in the morning and into the afternoon. 4 on tap for Monday. Total vehicle sales for September. This 13.2. This is recessionary level. When you think 2016, 2017, going even into 2018, 16.5, 17.5 million vehicles per year. 13.2. You're already at recession levels. The next day, in case you didn't understand what they were saying the day before, 3 more are going to come out in rapid succession and read the riot act to you, just in case you think that you're going to have a good day. You have factory orders, and then we have the JOLTS data. This is saying low, but it just seems to be elevated attention right now. How many job openings versus quits? If you see the quits drop below 4 million into the 3 million, that's very good in terms of the Fed getting the job done in getting some slack in the labor market. And if you see the job openings dropping down as well, then we know that that's heading in the right direction. Not positive for the economy, but positive for the end of the rate cycle. And just in case there's good information and good news here, you got two more speakers that are going to come out and read the riot act to you if you decide that you want to rally. Mortgage applications the next day, ADP, employment change. Now they have changed the way that they count and the way that they estimate, because they were wrong for years and years and years. And a couple of months back they said, okay, we're gonna stop this, and we're going to retool our algorithm and reintroduce the number. Still, you know, way back when I first was doing this, the ADP report was always referred to as the always wrong ADP report, because it was just always wrong. So I don't know if anyone really pays attention to it, but they report it anyways. Next in the U.S., balance of trade, exports and imports. Then you have your PMIs, global services PMI, S&P, and the ISM non-manufacturing followed up as well. And again, for services, I believe they have 50 as their number. For manufacturing, it's 46 on ISM. So 50 is the number to watch. Forecast 56, that's still expansion. Where is it? New orders. That'll be interesting to see. And prices paid will be interesting. We'd like to see that come in well below 71.5. Like a nice big drop would show inflationary pressure decreasing in that space. Another Fed speak. Continuing jobless claims and initial jobless claims. Again, the higher it goes, the better it is in terms of the nearing of the end of the rate hike cycle, because employment box is checked, inflation is not, so they're willing to keep going until they break employment in the name of fixing inflation. So the weaker this gets, the more likely they are to say, okay, let's just slow down here. But the stronger this stays, well, you know, then the end is a little bit further away. More Fed speak. A lot of it going on, and more Fed speak just before you get the labor numbers for both Canada and the US in terms of how many jobs were added. And of course, we're going to be looking at this participation rate. It did increase last month from 62.1, I think, to 62.4. Let's see if it increases again, that the supply of labor is increasing. Hours worked per week. Let's see if that increases or decreases. The decreasing is in line with an economy that's saying, oh, okay, let's just take it easy, because usually overtime hours are cut before staff is cut. Average hourly earnings was at 5.1. Anything lower than that would be negative, because, well, then you have real earnings that are actually shrinking over time. So this is the big one for the week. In case it's good and it's bullish, this guy here will beat the crap out of you at 10 o'clock and tell you, hey, you think we're done? We're not done. So even if this causes a rally, this guy's going to sit on that rally for you. And there you go.